In this video, we need to talk about the banking crisis. Not only do we need to talk about the banking crisis and how things are actually unfolding, but what I'd like to do is look at what The Economist tells us about left tail risks along with Goldman Sachs. Now, left tail risks are lack of growth risks. Think about it like a bell curve, okay? If in the middle we're growing steady, if on the far right we are hyperinflating and things are basically taking off in such a way that we have to get Paul Volcker. The left tail risk is really that, we have damaged the economy too much. The Federal Reserve has gone too far in hiking, and we are going to be in a dirty and deep and dark recession. Well, in this segment, we've got two important pieces to cover. One, I'm going to give you the economist's conclusion on whether or not we are going to face a deep, dark, and dirty recession. The Economist, by the way, one of my favorite publications, and I think they are very, very good. Just know if you read The Economist, they don't like Donald Trump and they lean left, but they have very, very good economic insight anyway. And notice, you can still like people who have different political opinions than you. That's very important. But first, let's look at Goldman Sachs, because Goldman Sachs has some neat look, or a neat look, should I say, into exactly what's going on with the banking crisis. Goldman Sachs obviously is massive financial partner. It's one of the biggest 10 banks that we have in the country. It's also a huge financial partner for Apple. They back the Apple credit card, so they're getting a lot of data on consumers. So when Goldman Sachs tends to give us some insights, I like to pay attention, although I don't take everything at face value of what these individuals like to say, because they can be wrong. But then again, everybody can. So, but it's good to look at perspective. So, speaking of perspective, let's hop into it right now. There we go. And let's throw up the coupon code. There we go. Okay, fantastic. So first, let's start here on the banking crisis, and then we'll talk left tail risk. So this segment was very interesting. They say here, further signs of stabilization in the banking system. Although money market funds continued to see largely institutional inflows, the pace declined by about roughly half of that seen in the prior week. Now, we've talked about this before, this idea that the banking crisis is stabilizing. You're actually seeing small bank deposits level out. In other words, these were small bank deposits, then they fell, and now you're kind of getting this leveling of small bank deposits. It really feels like the banking crisis has slowed or come to a halt. Goldman Sachs here tells us that even the pace of money market movements has slowed. We've talked about this yesterday about how discount window borrowing at the Fed has also slowed, and that really the Fed's lending to bridge banks via the Bank Term Funding Program, in other words, by the Fed pivot, although I don't really think that's the Fed pivot, it was just really a tool that they deployed, is also stable. And what they talk about here is really this idea that last week we were talking about how this scramble for dollars had gone global. Remember when I came to you from a ski resort talking about how the Fed was injecting liquidity via new daily liquidity swap operations on a Sunday? That we expected it would be one-off. In other words, they're really saying, look, we had this sort of one-off crisis where everybody was freaking out. But so far, every indication of struggles is waning. The demand for the dollar is waning internationally. This is not to be confused with the petrodollar. Okay, I'm talking emergency lending dollars. This is different topic. Okay, we can talk about the disappearance of the dollar in a different video. People keep bringing that up, but it's just not that important right now. So discount window borrowing, bank term funding facility, money market movement, small bank movement, and a dollar movement, all relatively stable. This is actually phenomenal insight, right? We want to pay attention to stability in the banking crisis. And so really the question then is, okay, well, how is the banking crisis really going to affect us? So let's see here. North America, United States, yield response to near-term news potentially asymmetric. Our baseline view is that credit tightening resulting from the current banking turmoil should be contained. Listen to this. So many people are saying that's it. Our economy is going to go into a deep, dark recession because, oh my gosh, what about all of the credit tightening? Oh my gosh, Kevin, quickly change the banner to the paid promotion on life insurance, metkevin.com/life, because everything's going to hell. The reality is no. The reality, frankly, is no. The banking crisis is not that big of a deal. I was having actually a slight debate about this yesterday. Somebody was asking me, but Kevin, like, big banks, they're going to be forced to lend less. And I'm like, How many times have you gone to a big bank for a loan in real estate? And if you're not familiar with going to big banks for loans, you know that you don't go to big banks for loans. You usually go to smaller banks for loans. And then there's the thought, oh, but they're going to regulate smaller banks more, right? No. Guess what the Biden administration just talked about? They talked about how we're not going to punish the big banks because they've already been punished. Well, then we're going to punish the small, right? No, because that's not fair to the small banks. So whom are we going to punish then? Let's punish the medium banks. I kid you not. You can't make this stuff up. The Biden administration now wants to punish the medium-sized banks and tighten lending standards at medium-sized banks. And I believe what this is going to do is basically turn the medium-sized banks, the more closer to systemically important banks, that 250 mil bill threshold rather, and you're going to see the medium banks become more regulated like the larger banks. So we don't have another Silicon Valley Bank, which basically just means the smaller banks are going to be like, we just had a lot of deposit outflows. You know what that means? We're going to have to get more creative to bring customers back. How about better mortgages, business loans? You want rental property lines of credit again? What could we come up with to bring customers back? They will come up with an endless suite of lending products. And I believe you already know this, so this I don't want to sound redundant. You already know that I am of the belief that we are in a Nike swoosh style recovery that we now I believe are in the beginning of what will likely be a 10-year bull run, my opinion. But guess what I think is going to add fuel to the fire of that bull run? It is none other than small bank lending taking off to support a return of deposits to small banks, and they're going to do that by enticing you with cheap loans and beautiful, sexy loans, beautiful, curvy, delicious loans that you can't get anywhere else, and we'll be tempted by those and drawn in by these delicious loans, and we'll just have to go back to the small banks and re-engage relationships. And then you know what the small banks are going to do? They're going to say, hey, look, we know you have concerns about the FDIC limits of 250K, but you know what? Look, we have made a menu for you. If you open up this account and this account and this account and this account and this account, we could get you up to $3 million of FDIC coverage. Just have multiple different business accounts and multiple different LLC accounts and multiple different accounts of this, and all of your deposits will be protected. In fact, if I was a small bank right now, that's exactly what I would be doing. If I was a small bank, I'd be thinking about exactly how I'm going to milk FDIC for everything it's worth. I would start LLC formation within my bank, and I would be like, dude, let's just create another LLC, and then you're going to put 250 into that subsidiary and 250 into that subsidiary of your business. And guess what? We'll basically make it easy and seamless for you to always be FDIC insured. In the meantime, you want some sweet, sexy, delicious loans, because guess what? The big and medium banks ain't going to be able to provide for you, but we can. I'm telling you, it's like the game is just hilarious. I strongly believe in it, and I actually think it's a good thing because it'll contribute to a bull market. And yes, is risky financing risky? Absolutely. But worst case scenario, small non-systemically important banks go kaput, and who really cares? And the people who bank at those banks will be enticed to be at those banks under the promise of FDIC insurance. And then guess who's really going to pay for the small banks taking risk? The medium and big banks once again. It's corporate socialism, folks. So the banking crisis really isn't that bad. But anyway, well, listen to this. The credit tightening will likely not be large enough to push the economy into recession or force the Fed to ease aggressively to the extent markets appear to be anticipating, even in a probability weighted sense. Why do they talk like this? They talk so complicatedly. Basically, they're saying, yo, credit crisis ain't going to be at bad. Don't worry. People are overblowing credit crisis. That's all they needed to say. But I'll go back to their words. Even in a you know what, it's hoity-toity. Even in a probability-weighted sense where we ascribe increased odds to a recessionary outcome, we believe yields have declined too much. Who writes this trash? This is basically saying people have fled to bonds. Despite this, we do not think fading this pricing via duration shorts is particularly attractive in the short term. In other words, don't even though we don't think that even though we think that bonds are going to fall and rates are going to go up, it's probably not a good idea to short. So even though we say this, don't bet on it. By contrast, restoring full confidence and assessing the impact of diminished credit provisioning could take time. This is something we do hear about as well. the lag that it takes to actually get any kind of credit tightness. This is something we do regularly see is this idea that it could take potentially 6 to 12 months. But take a look at this. Banking turmoil's distributional effects on rates, the evolution of the options implied skew of risks to interest rates has largely mirrored our own views, though with some differences in magnitude. On the front end, we believe the recent events significantly reduce the odds of a much higher terminal rate. Though our baseline projection is roughly about 30 bips above the markets, but the increase in probability of deep cuts is probably a little too optimistic. In other words, investors are clearly much more concerned about recessionary left tail risks, and that's why investors are pricing in all of these cuts. But the reality is the economy has been incredibly resilient. And that's where we have to get into the next pieces on how resilient the economy has been. I mean, consider what the Economist says. JPMorgan has some insight into this as well. Morgan Stanley, Citibank gives us some credit card data. We'll go through all of this quickly here. But what does the Economist tell us? The Economist, I wrote this down here because I thought it was a fantastic piece here. The Economist says the current activity index released by Goldman Sachs is steady. So even through the banking crisis, we haven't actually really seen current activity fall. The Purchasers Manager Index, which would be a leading indicator of stress at manufacturing, steady. Weekly measures of GDP, steady. Is it really maybe just that we're too early to see the recession at the moment? Well, Ipsos finds that American confidence in the economy during the banking crisis is actually growing. Maybe it's rigged, but the Economist is like, why are people so blasé? And I actually have a very interesting idea about why people are so blasé. Potentially because people are like, dude, we just went through war basically with Russia. Not only did we go through war with Russia, but we went through a pandemic. We made lots of money during the last 2 years, so we have a lot of extra stability, more stability than we previously had in 2019. That's not to say there still isn't poverty and there still aren't food insecure people, which is terrible, and the government should do something about that. But in many regards, the government as a whole is relatively incompetent. And that's like, if you work for the government, I believe in you as an individual. I don't believe in the entity totally, in total. The sum of its parts are not greater than the parts itself. Anyway, so point being, yeah, I think there's actually a really good chance the reason people are so indifferent right now is because they have money to just continue to spend. And like the things that are occurring at this point, we kind of just roll our eyes to. It's just like, okay, Putin's yapping again. All right, we're over it. Another COVID variant. All right, really? Like, you expect me to get like excited or agitated now? You think I'm going to go sign up for your life insurance just because you mentioned another COVID variant, Kevin? That's wishful thinking. Although I would like it if you checked out mettkevin.com/life. I think it'd be pretty cool. It's a paid promotion, but they're pretty awesome. But anyway, um, really, the resilience is very, very clear here. Now, let's look at what JPMorgan has to say about this because they have a phenomenal piece on this as well. Let's throw them up on screen here. There, one of these is the better option. I gotta label these. StreamYard lets you label these in a pretty cool way. That was the Moscow piece we covered. I can't figure it out now. That's not the best example of StreamYard right now, Kevin. You're screwing it up. There we go. So, but that's just my fault. I'm just pushing the wrong buttons. All right, here we go. So, what does JP Morgan say? Recession forecasts have been moved back modestly, and easing expectations have been brought forward. The upshot of these developments is that recession narratives built on the view of private sector fragility are being challenged. In other words, we're like stronger. I actually wrote this. I go, maybe COVID and war and such were like a dress rehearsal for hard times ahead, right? But anyway, JP Morgan says the private sector fragility, in other words, the weakness of the private sector, the idea that the private sector is weak is really being challenged, and that downbeat near-term economic forecasts are becoming far more reliant on the emergence of disruptive financial market developments. In other words, everybody's paying so much attention to this banking crisis, but the reality is it's just sort of a bearish excuse in terms of, well, the economy is still doing well, so what are the bears going to talk about? How about a banking crisis? Now, in fairness, we did just have a banking crisis, but whoops, it wasn't that big of a deal. There was actually a piece from a Goldman Sachs trader. I didn't save it here. Actually, I saved it on my iPad. Let me just read this to you really quick. I thought this was really interesting. Bull case for tech. If the leading crunch because of this credit crisis is only 25 to 50 basis points to GDP. Secular growth technology companies benefit from growth scarcity. Okay, in English, the Goldman, who is this? This is Goldman Sachs Equity Observations. I'm trying to see who wrote this. Let me go to the end of it. I don't think it really matters, but it's a Goldman Sachs analyst is basically saying, look, if the credit crisis squeezes the economy by 25 to 50 bips, it probably actually benefits big tech because they could actually hold up their numbers to the pain of smaller technology companies. And they'll be able to more appropriately leverage the gains of artificial intelligence. Now, there are risks that we continue to face some form of wage price spiral and increasing labor costs. But if those risks go away, there is actually a very clear bull case for tech as the economy continues to be so resilient, especially since global GDP is still on track for 3.7% annualized gains. The US is on track for 3.3% annualized gains of GDP this quarter. That's phenomenal. That's not even below trend growth. Below trend growth would be like 1%. We're tracking at 3.3 right now. So yeah, maybe it's coming. Maybe the pain is coming, but current strength has been very, very well strong. Now, JPMorgan doesn't actually think that current strength is going to stay. JPMorgan thinks we are going to end up in a recession towards the end of the year. JPMorgan suggests we've had some upsized surprises on retail sales. And I thought this was really incredible. Listen to this. Even though JPMorgan is convinced we're going to see a recession, look what they wrote here. The gain from real consumption did not come from a drawdown in savings, as strong gains in the labor market and reduced energy prices actually helped support real disposable income growth at an average annualized rate of 6.5% over the past 2 quarters. So even though corporate profits may be moderating, they're far from falling the way a lot of people expected, and profit margins remain stable, which really aligns with what we've seen with this idea from Goldman that big tech could actually win in this. Pricing power style stocks could win in this. We talked about non-bank lenders as well. Well, actually, we didn't talk about non-bank lenders. We talked about small banks being a little bit more sort of like, maybe if they're going from wearing like a bathing suit to going to wearing a bikini and a thong, like they got to turn up the sex appeal a little bit. We expect that to happen. But there are also non-bank lenders, whether that's private money, whether that's direct lenders for mortgages. They're the ones who usually have easy credit for you. So this idea about significant stress in the financial system. We're just not seeing it right now. And JP Morgan talks a little bit about how these are not necessarily indicators that are going to push us into a recession, even though their base case is still a recession. Now, JP Morgan also suggests here that actually this is just sort of a reiteration of what we just talked about, so let's skip that. Let's now look at Morgan Stanley right here. So Morgan Stanley had a piece on tighter credit, and then I want to look at credit card data from Citi. Credit shocks take a toll on the economy, but they take time to build. Tightening credit conditions should drag down global growth in the second half of the year. And additional loan growth deceleration will potentially pressure GDP by, oh my lord, 1/3%, or I'm sorry, 10 basis points. Really, Morgan Stanley? You think tighter lending standards are going to affect a GDP growth in the fourth quarter by 10 bips? Nobody cares. Like, this is so minor. Even these estimates and Morgan Stanley is being a bear in this piece, they're not that big of a deal. Our banking analysts see a meaningful increase in funding costs ahead, so you haven't yet seen them, which will likely lead to tighter lending standards, slower loan growth, and wider loan spreads than previously expected. The stage is now set for an even sharper deceleration in credit growth over the course of the year. This is the base case, right? That we're going to see a loan slowdown potentially of 11% by the fourth quarter of 2023 compared to the fourth quarter of 2022. I'm sorry. This is down from 11% in the fourth quarter. The bear case would bring us to 2% loan growth at the end of 2023, compared with a baseline of 4% loan growth. So, in other words, Morgan Stanley is saying things are so bad, loan growth will only be 2% at the end of the year, whereas we want it to be 4%. Even the bears are starting to sound a little weak here. Within GDP, the impact to consumption and business investment is roughly equal. They say a quicker resolution. Oh, look at this. They actually hedge their bearishness. They say risks around the outlook are large and two-sided. A quicker resolution of financial system troubles could see the economy remain on solid footing. Yes, in line with recent payroll prints. On the other hand, a more nonlinear tightening of financial conditions from here on could see larger and more rapid deteriorations of growth in the labor market. Yeah, if we see more tight loan growth, but we're not sure that we're actually going to see this. Everybody's talking about it, but as Nat West told us last week, the short-term indications are far and few between that we're actually seeing any kind of credit stress. The biggest irony is going to be that if we end up going through this cycle and everybody's talking about recession, everybody's talking about this credit stress, and it just never ends up happening. So then we have here, all told, they see a negative 1 percentage point shock to real GDP. A negative 1 percentage point shock to credit growth ends up decreasing real GDP by 20 bips. Okay, so if you're 2% below trend, so you're 40% lower or 40 basis points lower on GDP, it's relatively a nominal impact. So Morgan Stanley does go a little bit further on, and then I want to look at credit card data with y'all. So at this time, our estimates lean heavily on the variation of data in the 1980s and 90s, a time when the banking sector was more prevalent in terms of a source of financing. Today, bank lending only accounts for 1/3 of all private non-credit relative to 50% in the 1980s. Okay, let me translate that to English for a moment. So in English, and this relates to what we talked about at the beginning of the video. Come here, Jack. In English, today we are 20 percentage points less reliant on big banks for lending than we were. Careful with the cable there. Than we were in the 1980s, the last time we actually had to worry about credit shocks. What's up, dude? Did you just wake up? You want to come say hi to everyone? Awesome. So anyway, really, this is not that big of a deal. In comparison, a 100 basis point increase in the Fed funds rate lowers growth by around 40 basis points. That's fine. So really, even Morgan Stanley here, a bear, is hedging this idea that maybe it's not going to be as terribly as expected. So these right here are impacts on GDP. Okay, let's go to the, let me see if there's anything else that I really want to hit from this Morgan Stanley piece. They do think more potential layoffs in Q1 24. I find it interesting that we continue to see a delay of when we're actually going to see these layoffs. It just seems like it's always delay. Everything keeps getting pushed back because the economy continues to be strong. However, technically employment is sensitive to credit tightening, but as it was during the Great Recession. But remember, the Great Recession was a global or great financial crisis. Are we actually really going through a financial crisis right now? Or are we just going through, dare I say, transitory inflation? We do not expect the actual implications for job growth to be as significant this time around, because this time is different. Given staffing shortages in the economy will likely continue to support labor hoarding this year as economic growth slows. Further, we think limited upside in labor force participation will keep the unemployment rate relatively low, somewhat offsetting the significant slowing in jobs we expect. Okay, in English, once again, before we get to credit card data, Morgan Stanley is a bear because they think we're going to have a lot of credit tightening, which will slow GDP, and you'll have low loan growth. However, they're going to hedge that by telling you the big banks don't even matter that much anymore. And maybe people will keep labor hoarding, which means people will keep having money, and we're really just going to end up spending through this recession. The biggest risk to all of this is that inflation skyrockets. If inflation skyrockets, we're screwed. Then all these problems come to a halt. Now, let's quickly look at credit card data. So what do we have for credit card data? Citi's credit card data across 16 subsectors, not including spending on services. I read that and I'm like, that's stupid. Showed the weakest spending since April of 2022. Now, that's great for disinflation, but potentially not that great for economic growth. So I do want to bring that up. They do talk about, though, that likely the disruption in the financial sector briefly led to a divot in spending. I noticed in a YouTube ad spend that it seemed like YouTube ad spend did a little bit of this during the banking crisis, that there was somewhat of a trough basically because of the banking crisis. And so it's likely that this credit card data And this weakness may be temporary because of the banking crisis, though it's something we'll want to pay attention to. I'll show you a few things in here. First, I'll show you that there was an acceleration in pet stores, up 8.5% over the prior week, and a decline in e-commerce pure play apparel, appliances, electronics, home improvement, and home furnishings. You can see the percentages on screen here. But yes, Jack. You can. Bye. Jack says bye. You're welcome to grab a sandwich from the refrigerator as well, the ones with Jack on it. All right. So this is an important chart over here because, in my opinion, it just shows you the trajectory and shows you, that these negative changes really are something we've seen for a while. Look, for example, at home improvement. There was really only 1 week people spent more money on home improvement. It was Christmas of 22. Otherwise, home improvement has been negative across the board. You could see that here. You could see that electronic spending has been negative across the board, so not a surprise. You could see that pet shops and pet foods and supply positive for retail spend for the entire last, on a weekly basis, 4 months, 3.5 months. For 3.5 months, pets have been positive, not a single break in that. Appliance stores have pretty much been negative the entire time. And as a result, overall spend has declined pretty much with the exception of the week of Christmas over the last 4 months. So there is this potential idea that, yes, look at this chart here. This shows you that we could end up seeing that earnings crush that Morgan Stanley's Mike Wilson keeps talking about. But look at how this chart, how beautiful this is. This shows you normal growth in 2019. Then you get the COVID pandemic and you get this crazy V-shaped recovery here where basically retail sales fell around 10.7%. And then they started increasing. Then the stimulus money hit. When the stimulus money hit, boy, that's really when spending skyrocketed. The different rounds of stimulus, we really saw spending balloon on a weekly basis, averaged out over here by month in 2021. And now we're getting into that recessionary territory. So yes, in fairness, retail sales are going down, but it is entirely possible that the market's already priced in some form of EPS declines for some stocks. And even if, as long as inflation goes away, if we can look through some EPS declines, which are expected to show up, the market does not necessarily have to decline solely because of EPS declines, because a lot of those may end up being priced in. We see these leading indicators from a mile away. So very, very interesting. I'm a big fan of that. Yeah, look, I mean, for me, again, every single day, what do? I read reports on the banking crisis, on consumers, consumption, on what's going on at companies, earnings calls, and I'm trying to understand where the risks are. We've been saying for, I would say, over 6 to 8 months now, there is no wage price spiral. And the inflationary data is fantastic, but that doesn't seem to be the big concern now. Now the big concern seems to be the recession. Banking crisis briefly, but so far that's turning out to be a nothing burger. And the idea that bears are amplifying the banking crisis as a reason for why spending in EPS is going to decline more is the only reasonable argument that's left. And it is a reasonable argument. I will not say the bears do not have a point. They have a point. EPS could decline substantially more meaningfully than we expect. But so far, with labor hoarding and the reports that we're getting on earnings, things aren't looking that terrible. So I'm very, very excited for the future. I'm very optimistic. Maybe I'm too optimistic, but that's my thought. So hopefully that's very insightful for you on the banking crisis.